This is Professor Mayer, and this is our second chat, and we're focusing on internal controls, primarily internal controls, internal audit, and then we're going to focus on a specific area, which is controls over cash and short-term investments. So as we're going through this material, what we really want to focus on is internal controls, the internal control process, and internal controls over fraud, internal audit, audit committees, and then we're going to talk specifically about controls over cash and short-term investments. So there's a couple of classes that we focus on internal controls. You may have taken the auditing class. You may have also taken the internal auditing class. I had the opportunity of teaching that last semester, and I've taught the auditing many times over the past couple of years. In any event, the idea of internal controls is that it really forms the basis of a structure within an organization where we want to do things right. And there are very specific internal controls. We're going to talk about these. We're going to talk about internal controls from the perspective of how we can incorporate these in a business. We'll talk about fraud. We'll talk about the internal audit function, specifically as it relates to their role related to the internal audit function. And then we'll talk about the audit committee, and then follow up with some very specific things related to cash, short-term investments, and things like this. So one of the items that I want to kind of bring out is, what is an internal control? Well, the internal control is a process that is put in place by management to prevent bad things from happening. And I always liken this to the fact that everyone probably locks their front door at night. Well, why do you lock your front door at night? Well, you lock your front door at night because you don't want people coming in, you don't want people to come and disrupt your life and steal your valuables and do harm to your family. Now, when you lock your door at night, you do this on a routine basis. You're not really even thinking about it. And at the end of the day, when you wake up in the morning and you find out that nobody tried to break into your house, are you going to say, oh, well, I don't know why I implemented this internal control of locking the door, nothing happened, and that was all wasted energy? No, you don't do that, because the issue is that the internal control is a process. The process prevents, to some extent, these bad things from happening. If someone really wants to do harm to you or to your organization, they can probably get around these internal controls. But the basis of internal controls is these are structures in place to prevent bad things from happening. And these bad things that are happening are what we call risk. So again, back to the front door. There is a risk that something may happen to you or your property. How do you mitigate this risk? You mitigate this risk by putting a lock on your front door. It's as simple as that. So when we're talking about risk in a business, what we want to think about is, what are the things that we can implement to reduce? We probably are not going to be eliminating it 100%, but we're going to be able to reduce the potential that this risk could take place. And again, the risk is the potential for something bad to happen. The internal controls are there to mitigate this risk. And what becomes interesting as we apply this, and we'll talk specifically about controls over cash and short-term investment. So what's an internal control? It's the whole system of controls, financial and non-financial, established by management to carry on the business of the enterprise in an orderly and efficient manner, to adhere to management policy, safeguard assets, and ensure, as far as possible, the completeness and accuracy of records. Now, I want to kind of focus in on a couple of items here. As you notice that the internal controls, they're both financial as well as non-financial. They're established by management. It's critical to understand that the internal control structure is a top-down approach. So management needs to implement these controls. Management needs to create an environment where internal controls are accepted as the standard practice. So we need to have some very strong internal control structure at the top of the organization. The issue related to internal controls is efficiency and effectiveness. And you notice that what we are really focusing on is safeguarding assets, the completeness and accuracy of records. So we're talking primarily here related to the financial statement. The one thing that we want to really focus on related to this process is understanding that internal controls go beyond just the financial statement. Safeguarding assets is kind of a subset of what we're talking about here, but ultimately everything is going to flow into the financial statement. So why our internal controls are important: integrity of assets, integrity of financial reporting, operations, and so let's talk about this before we talk about the types of internal controls. So the first two pieces that we want to focus on is that when we talk about internal controls, we want to make sure that the internal controls are in place to maintain the integrity of assets. Assets are the resource of the organization. We do not want the resources of the organization to be used for things other than promoting the business of the organization. So it's critical that we maintain control over these assets. So it's very possible that these assets, whether they're supplies or equipment or cash or any of these issues or any of these items, that they are retained within the organization, that they're not used by employees or stolen by customers. So the integrity of asset is critical. When we talk about the integrity of the financial reporting, it's very important that we understand the integrity of the financial reporting is the internal controls over financial reporting. And if you've had the auditing class, in auditing we talk about the Sarbanes-Oxley Section 404. Sarbanes-Oxley Section 404 essentially defines the internal controls over financial reporting, and we're using basically what we call the COSO framework. The COSO framework of internal controls is the internal control structure, very similar to what we're going to be talking about this evening. But ultimately, internal controls over financial reporting are in place to provide assurances that the financial statements fairly present what is the true financial position of the organization. We also consider internal controls from an operational perspective. So when we think about operations, we think about the effectiveness of operations, we think about the efficiency of operations. So when we talk about operations, we want to make sure that we're doing things right and we're doing the right things. So the efficiency is the doing things right, making sure that there's not a lot of steps that could be eliminated, and the doing the right thing is the effectiveness. We want to make sure that what we're doing from an operational perspective in fact matches the goals of the organization. Assets, financial reporting, operations, and in fact as we talk about internal auditing, what we're going to talk about is the internal audit department becomes critical in terms of their role related to improving the operations and effectiveness of the organization. Now, you notice here related to internal controls. Internal controls is there are preventive controls. Preventive controls are these controls that prevent bad things from happening. So the preventive controls essentially are, again, very similar to the lock on the front door. The lock on the front door prevents these bad things from happening, or at least reduces the risk. And again, any internal controls, there's no guarantee that the control is going to be effective. But what we're looking for is we're looking for the effectiveness to reduce or to mitigate the risk. So again, when you think about preventive controls, we're thinking about controls that are preventing these bad things from happening. When we think about detective controls is kind of like after the fact. So the detective controls essentially are in place to review from the perspective of what, once something bad has happened, we're going to determine and detect where the weakness is. So as an example, a video monitoring system may in fact be preventive, but it's also a detective control, because if we didn't actually witness this item, it's very possible that the video actually detected something taking place, and we can go back and we can review this. Okay, so designing preventive or detective controls essentially is addressing the unfavorable conditions arising from risk. So let's again redefine this concept of risk. When we talk about risk, what we're focusing on is the potential that something bad has happened. Doesn't mean that something bad has happened, it just means that something bad could happen. So when we're looking at internal controls, what we're attempting to do is we're attempting to address these things that could happen. We want to prevent these, or if we can't prevent them is we want to have these detective controls to determine what actually took place and how we might be able to prevent a future event. Given the fact that this is a class related to the controller, let's talk about where the controller is in relationship to internal controls. Okay, so the controller is generally responsible for very specific financial departments within the organization. And I think we talked about this in our last lecture. He or she is probably responsible for payroll, maybe responsible for human resources, probably going to be responsible for purchasing, definitely going to be responsible for financial reporting, maybe responsible for accounts payable. Again, it sort of depends upon how the organization is managed. But the controller essentially is responsible for these organizations, but also is responsible for these groups from the perspective of maintaining an internal control structure. So it's the controller that essentially is responsible for the design and the maintenance of these internal controls. Now, that being said, and again, we talked about the COSO framework of internal controls. COSO framework of internal controls essentially states the fact that internal controls is a top-down approach. So the top-down approach is starting with the board of directors. So the board of directors essentially is defining this tone at the top. So you're going to hear in a lot of your classes this whole concept of tone at the top. Tone at the top essentially is where management at this very senior level and at the board level are defining a ethical environment within the organization. This essentially is coming from the board of directors, and a subcommittee of the board of directors, the audit committee, is responsible for two things. They're responsible for the internal audit. It says internal audit staff. I would probably change this to say the internal audit function, in the sense that the chief audit executive should be reporting directly to the audit committee from a decision perspective. From a day-to-day operation perspective, he or she may be reporting to the controller or the CFO or the president, but from an oversight perspective, the chief audit executive is going to be reporting to the audit committee. So the chief audit executive is defining the audit scope. He or she is defining what audits are going to be done during the year, and what becomes important is going to be emanating from the audit committee. Senior management, and again, kind of think about sort of the relationship between the board of directors and senior management. So the board of directors is the group that represents the owners of the corporation. This board of directors then appoints the executives, the chief operating officer, the chief executive officer. All these people are management, but they are appointed by the board of directors. So the management is responsible for the day-to-day operations. They're also part of this tone at the top. And then again, kind of think about this, is the internal audit staff maintains its independence within the organization because the internal audit staff is reporting directly to the audit committee, and the audit committee is directing their activities in terms of what they're looking at. So the internal audit staff is reviewing internal controls, they're reviewing existence of internal controls, the effectiveness of internal controls, and we'll talk about that over time. And then the independent auditor, so let's talk about this person right here, or this group, is the independent auditor is now creating or developing and reporting on an audit of the financial statements. So the external auditor is making recommendations, completing an audit not only of the financial statements, where the external auditor is providing an opinion of the fair presentation of the financial statements, but they're also making recommendations related to internal controls. And then this term right here that I had already mentioned is the internal controls over financial reporting. So the internal controls over financial reporting is a requirement of the Sarbanes-Oxley Act 404, and in the internal controls over financial reporting, the management through the controller and the CFO are identifying and testing internal controls over financial reporting, and they are testing to these. The CFO and the CEO must attest to the internal controls over financial reporting, and then the independent auditor, the external auditor, will also follow up and complete their own audit of internal controls over financial reporting, and then not only provide an opinion of the internal controls, but also provide an opinion of what management is stating related to internal controls. Okay, you're probably getting dizzy. You're getting dizzy because we're talking about internal controls, and internal controls are one of these things that are very, very, very important within an organization. And when we talk about internal controls, we want to make sure that transactions are done in accordance with management's authorization, that they're recorded appropriately, that custody of assets is in accordance with what management rules are. So the idea is that if as an example, if the asset is a company vehicle, is we want to make sure that the people aren't using that vehicle going on vacation, okay, using that for their own personal use when in fact it is the asset of the organization. So the next piece is custody of the asset permitted only in accordance with management authorization? Is there a periodic reconciliation between assets and records, and are safety measures being adhered to? So these are just some examples of internal control issues within an organization. Now you notice we talk a couple times here, we use the term management authorization. So again, just to focus on the fact that management is responsible for determining what it is that they want to do. So if they are essentially developing a strategy for the organization, they want to make sure that everything, the resources of the organization are flowing to support the strategy of the organization. And this is really what the internal control structure is. And as we go through this presentation, one of the things that we'll talk about is some very specific things related to internal controls. And let me just go back over here and just highlight one item here. Transactions with management authorization. Okay, so I'll give you just a perfect example of a transaction that possibly could take place without management authorization could create problems. So in the revenue cycle is one of the things that should be taking place at the very beginning of transaction is validating the creditworthiness of customers. Well, we want to validate the creditworthiness of customers from the perspective of exactly, is developing a credit rating for these, identifying the line of credit, all these things. And the reason we want to do this is, guess what? We want to get paid. As an organization, we want to get paid. Just selling things doesn't quite do it. We got to sell it and get paid. And the getting paid part is sometimes the hard part. So the hard part in terms of getting paid is making sure that we're selling to people that have a high probability of getting us paid. Well, the problem is the sales department, what are they interested in? The internal controls that management is in place is basically to make sure the customers that we sell to are customers that we are going to get paid. So this is a management authorization, and the control structure is in place from the perspective that we want to make sure that there's a high probability of getting paid to any customer that we sell to. Now, the self-interest of, as an example, the sales department may be that they're interested in sales. Well, they'll worry about getting paid later on, but they want to get sales. So if we were, as an example, to allow the sales department to make the authorization for sales contracts, this may in fact not be in the best interest of the organization. So we want to make sure that all these things line up from the perspective of making sure that the controls are in place. And again, one of these controls is making sure that the right people have the ability to actually make the decisions related to these transactions. So let's talk about internal control principles. When we talk about internal control principles, we want to make sure that we understand that these are some very specific things that management needs to put in place to make sure that these risks are eliminated or mitigated. And again, we want to make sure that bad things don't happen to the organization. And I always use the term bad things. We don't know what those bad things are, but we do know that if we don't have the internal controls are in place, is bad things can happen. You notice the first item here, and I just want to really emphasize this. And I just want to emphasize this to sort of a significant degree. Sound personnel procedures. The ability to hire good people that have ethical values that support strong internal control principles is absolutely critical to the organization. And we talked about this concept of tone at the top. Tone at the top essentially is developing this framework of internal controls, this ethical environment within the organization. One of the absolute, lead by example. One of the absolute critical elements of this is making sure that we get the right people. Well, who's in charge of getting the right people? The human resource department. And the more I sort of examine and pursue the internal control structure of the organization, the more I'm absolutely convinced that the human resource department is the vanguard of establishing this control environment. It's only through these very strong procedures in terms of hiring the right people, getting the right people, making sure that the people match the position, and making sure that the individual characteristics of the person match the goals of the organization. this is what human resources should be doing. So if you have a strong human resource department, sometimes you're going to get very upset with them because they want to do things a very specific way. But if they're doing things a very specific way because they're supporting this whole environment of an internal control environment, that's actually a good thing. You notice here this item here, segregation of duties or separation of duties, kind of alluded to an example of separation of duties in terms of the decision for the line of credit. Sales should not be developing this line of credit. The customer should be approved with a specific line of credit from a department other than the sales department. And again, the reason that we're doing this is making sure that the person that is making the decision on the credit is making it without any issues related to the fact that, well, if I make this decision, it may in fact impact my paycheck, which would exactly be taking place if the sales department did this. Proper authorization. Authorization is a key internal control. We'll give the example in the audit class is any checks, as an example, maybe over a certain amount, say $10,000 or $50,000, needs to be signed by a board member or a senior manager or two people. Whatever the case may be, is we want to make sure that the structure is in place so that one individual cannot essentially control more of the transaction than is necessary. Documentation and records. One of the things that we talk about in the auditing class is many, I would even suggest that most significant transactions that affect the financial statements are transactions that are based upon management decisions related to maybe reserve funds or allowance for doubtful account or depreciation decisions. All these things need to be based upon management decisions. So the issue becomes, we want to make sure that that these decisions are documented appropriately. So one of the things that our auditor has recommended that we do is that anytime there is a management decision, and again, these management decisions are essentially ultimately relate to these manual journal entries, they're done in such a way that they are documented. They're signed off by maybe the chief accountant, the controller, and if it's significant enough, the chief financial officer. We document it, put it in a folder, put it in a file. And then when the auditor comes and the auditor says, well, why did you make this decision? You don't have to think about it. You just pull out the folder and you say, well, here's the documentation that we made related to this. You notice it's got 3 signatures on it. You notice that there's a 3 or 4 sentence or 3 or 4 paragraph narrative on why we made the decision. You can argue that we made the wrong decision, but the fact shows in this documentation that we made decisions based upon the objective information at that time. So that's what we're talking about, documentation. Again, documentation critical when we're looking at these manual journal entry transactions. Procedures, we need to have procedures. We do this as my company. We attach an email approval, backup. Yeah, exactly. And you know, one of the I live in a cooperative apartment here in Manhattan. Most of the apartments are here. I'm actually the treasurer, and anytime there's a transaction for whatever, flowers or whatever, is they send me the invoice and I simply just write in the email approved and my name and date, and that's it. So that would be documentation. My approval with the attached invoice then creates a scenario where that they can pay the bill, And when the auditor comes in and says, well, why did you pay this bill? You say, well, I've got an invoice. I got the approval from the treasurer. So, if it was wrong, there's more than one person that has their fingerprints on it, which is really what we're looking for. Policies and procedures critical to this. Physical safeguards, locks on the front door. If you have inventory that is fungible, meaning it's valuable outside the organization, make sure you have physical controls over this. Physical controls are the password policies of the organization to get into the system. Physical controls are where when the person terminates, you take their badge and you terminate them from the system immediately. So we want to make sure that these are the kinds of things that are actually taking place. Independent check is, again, making sure that again, internal audit is great at this, is they're looking at this from an objective perspective and saying, did it work, did it not work, whatever. Internal control policies, pre-numbered documents. Why are pre-numbered documents important? Is if everything has a sequential number, the first thing that you want to do is you want to look for missing numbers. And if you're familiar with some of the software out there like ACL or IDEA, is anytime you get a data file, you can actually search for missing numbers. Why are missing numbers important? Well, missing numbers may suggest that transactions were not posted appropriately. Doesn't necessarily mean that they were not posted appropriately. There may be a reason why these pre-numbered documents were not in order, but at least it gives you a starting point in terms of looking at these. Automatic recording of transactions, exactly, potential theft is absolutely a critical issue. So pre-numbered documents in terms of purchasing, receiving, vouching, all these things critical, because what we're looking for is we're looking for that missing number, and that missing number will or may, doesn't necessarily mean that it will, but it may be the key to uncovering some fraud. Automatic recording of transactions. The more automated the system, the better, assuming you have controls over the system. Now, I could spend a semester talking about this, okay? And I've done, I don't think hundreds, but tens of audits related to vendors. Absolutely critical that you manage your vendors. You notice this says pre-approval of vendors, and one of the things we want to make sure of is who has the ability to add a new vendor. Well, it should be purchasing. Purchasing should be in charge of vendor approval, and the approval process may and probably should include more than simply purchasing, but the vendor approval, and as we sort of click that box that says vendor is approved, the purchasing department should be that person. Purchasing department should be the only people that have the ability to add a vendor. We also want to take periodic evaluation of vendors. So periodically, we want to look at vendors. We want to look at vendors that are in our system that we haven't had business with for 5 or 10 years, and maybe 2 or 3 years. Maybe take them off the list. Maybe you want to use them again, but when we bring them back is that they need to go through that approval process just like everybody else. We also want to make sure, and I've seen this more than a few times, is the department decides they're going to use a vendor that's not in the system. So what do? They create this contract with the vendor, and then create, instead of going through the purchasing department, then do basically a check request through accounts payable to pay this vendor. Well, accounts payable now has an invoice, a check request, but no vendor, no purchase number, no receiving documentation, and frankly, When you see that, that essentially identifies a serious control weakness within the organization, because basically what that's saying is this department has circumvented all the internal controls in terms of purchasing, vendor approval, and has decided to go out there and engage a vendor, and now they're asking for this vendor to be paid. Maybe the vendor should be paid, maybe the manager that did this should be fired, but this, I've seen this before, and sometimes there's legitimate reasons for it, but it certainly, absolutely is something that needs to be evaluated from the perspective of why did this happen and why were the controls not in place. Okay, so I told you I could go on and on about this, but if I do, we're not going to get to the point. Okay, internal control policies, conflict of interest, variance analysis, periodic reconciliation, bank statement supplies, counting inventory, doing a reconciliation of your bank statements immediately is a internal control. That's a detective control. Doing a inventory count of your supplies, comparing that to your perpetual inventory system is a detective control. You don't know why there's a variance, but you do know there's a variance, and then you can investigate it. Variance analysis, I guess the easiest way to, as an example of this, is the budget process is an internal control process. And let's see if we can continue on here. Physical safeguards, we've talked about that. Training, segregation of duties, we've talked about that. So are we paying too much for materials? Great task for management to look at, and in fact, looking at this from the perspective of a Six Sigma project or getting internal audit involved with this would be a very good use of their time. Are we placing employees at risk? We don't want to put employees at risk. You put employees at risk, they get hurt, they get injured, you've destroyed their lives, and unfortunately, or fortunately, I would say fortunately, is then they get upset and they sue you. So the litigation mode, very inefficient, but when it works, it works very well and sort of stings the organization. So we don't want that to happen. So we want to make sure that we're doing right to our employees, we're doing right to our assets, and we're doing the right things. We've talked about this. Are we selling the customers that are unlikely to pay us? I've always said that the easiest way to increase sales is to sell to people that are not going to pay you back. Okay, so you get sales, that looks good, and maybe if you get sales at the end of the year to these people that aren't going to pay you, your financial statements at the end of that year look very good. Unfortunately, things are going to catch up to you in the following period. Are you wasting resources? Are you providing employees the necessary resources? Are you in compliance? Compliance to laws and regulations is a process of internal controls. When we talk about fraud, we want to make sure that we're understanding this from the perspective that we want to prevent fraud, and we want to detect fraud if we're not able to prevent it. Okay, as we talk about the fraud triangle. Okay, I love talking about the fraud triangle. Fraud triangle basically says is that the justification for fraud comes from an individual who has, number one, has a financial need. So this, my financial need may be, usually it's a he, or a gambling problem or a drinking problem. So that's the financial need. Hard times, yes, we've seen movies like that, no question about that. Rationalization is, oh, I've worked here for 20 years, nobody appreciates me, everybody's making 20% more than I am, and I deserve this, so I deserve to take this money, okay? And then the perceived opportunities. So an organization can't do too much related to these first two issues, although hopefully there's some means to help people. Maybe they have a drinking problem or gambling or whatever, but the fact is that they have a financial need, they have a financial need. It may be a legitimate financial need. Maybe there's a medical issue or something. Okay? Rationalization, this really relates to the organization providing a strong and positive work environment, so we can sort of mitigate that. But then the perceived opportunities are, if you are a potential fraudster, you have a financial need, you hate your job, you absolutely hate your job, you hate your boss, you hate everything about it, and you need money, and guess what? The internal controls are not in place, so you're going to create an opportunity to steal from the organization. So the perceived opportunity is where the internal controls are not there. So this essentially is the theory related to fraud, and this is the fraud triangle. Very interesting stuff, and you could make a movie out of it, which has been made many times, and it's always entertaining. And then, so we say the internal controls can prevent fraud. One of the things I just want to sort of point out is when we talk about fraud, there's two types of fraud that we think about. The first fraud that we sort of alluded to in the fraud triangle is the stealing assets, or the technical term of stealing is misappropriation of assets. And this could be an executive who misappropriates his or her travel expenses and takes his family on travel when in fact it's not appropriate. So that's an example of misappropriation of assets. The other type of fraud is fraud specifically related to financial statement fraud. Financial statement fraud is where managers are essentially managing earnings using, primarily using these estimate accounts that they need to make decisions on, manipulating these a little bit here and there to reach targets. And this occurs when there's a pressure to achieve targets. So the issue becomes is if you're 3 or 4% away from your target, which is the next goal, which is a very big bonus, and you're looking at all these numbers that you're dealing with, and you're realizing that a lot of those numbers are, we use the technical term, squishy numbers. Squishy numbers meaning they are subject to interpretation and management decisions related to estimates of reserves and so forth, is we can kind of be a little squishy with those numbers, achieve our target, and at the same time not sort of fall in a zone where the auditor would start questioning. And that's really sort of the issue related to earnings management. So if the organization has a high growth perspective, but in fact they don't have the actual growth to manage this, is you're going to start seeing things that we call earnings management to ultimately, the next level is financial statement fraud. So again, financial statement fraud and misappropriation of assets are the two types of fraud that an organization is concerned with. So as we continue on here, and we're just about running out of time, is internal audit. We've basically talked about internal audit in a number of these ways, but the audit function is the effectiveness and efficiency of internal controls as well as operations. So they're concerned with operations. I will tell you that I'm not necessarily sure I agree with the internal audit department is probably not the gap experts within the organization. There's, at least in any internal audit department that I've worked in, is I don't think that they're really there to make sure that the financial statements are prepared in accordance with GAAP. Now, they may in fact be there to help you evaluate whether the internal controls over financial reporting are working effectively. But in terms of GAAP, they're probably not exactly there. Okay. So when we talk about cash, we're going to determine, and again, we're looking at this from the perspective of the controller. If we need financing, when that financing should take place. We want to look at cash from the perspective of when we can repay our debts, estimating cash receipts, estimating cash disbursements. So the cash cycle, critical to the organization because people need to get paid. Employees need to get paid. Employees need to get paid every 2 weeks. Your vendors want to get paid within 30 days. And unfortunately, your customers, if you're getting paid on average 30 to 45 days, you're probably doing very well. Probably doing extremely well if you get paid within 30 to 40 days, which is extremely good. Well, the problem is everybody else wants to get the people that you're paying want to get paid faster than that. So the cash cycle is highly problematic and something that we need to be aware of. And as we're kind of flowing through the organization, we want to determine if in fact the cash cycle is working appropriately. Be forecasting similar using expected purchasing and payment patterns, strategies to accelerate cash, lockboxes, concentrated banking, electronic payments, more restrictive use of credit terms, offer discounts, pledges, and factor receivables. Okay, so let's talk about these. Factor receivables essentially is where you're selling these receivables to a third party. You get the money up front. You're not getting all the money up front, but you are getting most of the money up front. The discounts, so the idea is the more discounts that you give or the discounts that you give for early payment will encourage people to pay. More restrictive credit terms, so the idea is you restrict your credit terms. You're going to restrict your sales, but the people that you sell to have a higher perspective of or probability of getting paid. Next item is electronic payments. And you notice this lockbox. Lockbox is where the checks are mailed to a third party, which is a bank, and the bank immediately deposits this money. So the lockbox essentially reduces that amount of time of actually processing the check and being able to convert this into cash. Okay, so we've talked about some interesting things here. I thank you very much for your time and attention. This concludes our discussion this evening, and we have the next discussion in 2 weeks. Again, remember your homework is due on the Sunday before the session, and looking forward to our next discussion, and everybody have a great evening. Okay, thank you very much.